You are 36 years old. It is a Tuesday afternoon in late March, and you are sitting in your office with the door half open, your accountant's voice coming through your laptop speakers on a screen share call. A single number updates in real time on the shared screen. Your effective tax rate for the year, 8.4%. You stare at it for a second, unsure if it's a typo. 5 years ago, working the exact same industry, earning almost the exact same income, that number was 31%. You didn't win the lottery. You didn't find a secret bank account in the Caymans. You just stopped getting paid the way everyone else gets paid. You thank her, close the laptop, and step back out into the office to answer a stack of emails, same as always. Nothing about your life looks different from the outside. Everything about the math is different. To understand how you got here, you have to go back to when you didn't understand any of this at all. Flashback 9 years, to when you were 27. You had a W-2 job earning $82,000 a year, and every 2 weeks you'd open your pay stub and feel a small, quiet anger you couldn't fully explain. Federal tax withheld, state tax withheld, Social Security, Medicare. By the time it hit your account, a number that sounded respectable on paper had quietly lost almost a third of itself before you ever touched it. You weren't being cheated. You were just being taxed the way employees are taxed. First, before you get a say in anything. One night, scrolling through nothing in particular, you stumbled on a video of an accountant explaining a simple idea. Employees pay taxes on what's left after they live their life. Business owners pay taxes on what's left after they run their business. It sounded almost too simple to matter. But something about it wouldn't leave you alone. So you did something small. You started a single-member LLC around a freelance skill you already had. Nothing dramatic, no grand exit from your job, just a side business bringing in a few $100s a month. You bought a $40 book on small business taxes and read the whole thing in a weekend. Nothing about your bank account changed in any meaningful way. Your first year, the LLC made $1,900 in profit. You laughed when you saw the number. It felt like rearranging furniture in a burning building. But here's what the data actually shows. The wealthy don't get rich by earning more. They get rich by being taxed on a smaller and smaller percentage of what they earn. That gap starts small and almost invisible. It starts with a single LLC making less money than a weekend job. Not long after, a coworker got promoted into a director role with a big salary bump. Everyone crowded around his desk to congratulate him. At lunch, someone joked to you, "You're still messing with that little side thing? Just focus on climbing the ladder here. That's where the real money is." You nodded, said nothing, and went home that night and read one more chapter about depreciation. 2 months later, the same coworker mentioned, half complaining, half bragging, that his raise pushed him into a higher tax bracket, and his actual take-home barely moved. He earned more. He kept almost none of the difference. You didn't say anything. You just quietly understood something he hadn't figured out yet. How much you earn matters far less than how you're legally allowed to earn it. Time moved forward. You are now 29. Your side business is bringing in $38,000 a year in profit, still small compared to your day job salary. But this year, your accountant shows you something new, a solo 401k. Because you're both the employer and the employee of your own business, you can defer a meaningful chunk of that profit before it's ever taxed as income. It's not a loophole in the sinister sense. It's the exact same deferred compensation structure Fortune 500 executives use, just scaled down to fit a kitchen table business. You start pushing money into it every quarter. Your coworker, meanwhile, gets another raise and buys a boat. You don't quit your job. You just stop needing it to be your only plan. 2 more years pass. You are 31. Your side business has grown enough that you leave the W-2 job entirely, not out of desperation, but because the math finally makes more sense on your own. You form an S-Corp election for the business, which lets you split your income between a reasonable salary and owner distributions, reducing the self-employment tax bite. Your accountant walks you through it slowly, the same way she'd walk any small business owner through it. This isn't hidden knowledge, it's just knowledge most employees never get handed. Your former coworker gets another title change. He still complains about his tax bill every April like it's the weather. You've stopped complaining about yours. You've started planning around it. At 33, you buy your first piece of business property, a small commercial unit you operate your company out of. Your accountant introduces you to depreciation. The IRS allows you to deduct the wear and value loss of that property over time, even while the property itself is very possibly increasing in market value. On paper, your business shows less profit than it actually generates in cash. That's not a trick. It's the same accounting method every landlord, every airline, and every manufacturing company in America uses. You just didn't know it was available to you too. Just when things are clicking, the ground shifts. You are 34, and a slow year hits your business. Revenue dips. A contract falls through. For a few months, you seriously consider going back to a stable paycheck. You open a job board late one night, and an old, familiar comfort creeps in. The idea that someone else could just handle the risk for you. The tab sits open for almost 20 minutes. Then you close it. You remind yourself that the system you built isn't about one good year. It's about compounding structure over decades, the same way an index fund compounds returns. You stay the course, and you keep meeting with your accountant every quarter like nothing happened. The real shift doesn't come with fireworks. You are 36 again, back in that same office with the door half open, watching your effective tax rate settle at 8.4% for the year. Fully legal, fully documented, built from a solo 401k, an S-Corp structure, real depreciation on real property, and a holding company you formed last year to own your growing list of business assets. No parade, no trophy, just a laptop screen, a stack of unopened mail on the desk, and a quiet understanding that took 9 years to build. That afternoon, your old coworker, now a senior director, messages you out of nowhere to vent about his tax bill again. He asks, half joking, "How do you even do it? Feels like you barely pay anything." You could explain all of it. The LLC, the S-Corp election, the deferred comp, the depreciation, the holding company. Instead, you just tell him, "I stopped getting paid like an employee." He laughs, like it's a joke. You don't correct him. For years, you thought this was about beating the system. It wasn't. The system was never hiding from you. It was just written in a language employees are never taught to read. The real shift wasn't the tax rate. It was realizing the tax code isn't a punishment. It's a set of instructions for how the government wants capital to behave. And once you understood the instructions, you stopped needing to fear April. You still run your business every single day. You still answer emails, sign checks, and solve problems. But you carry a quiet, structural advantage most people never even know exists. You didn't cheat the system, you just finally read the manual.